Good afternoon. I have just sent already on the Edmodo page the notes for business finance. So later on, please find the time to download it. And then together with the PowerPoint presentation that I'll show you this afternoon, you can work on the review and on some questions that you might also want to raise for our next meeting. So allow me to share the screen. Last time, before I share the screen, let's remind ourselves of what happened last time. We had an introduction of business finance on why business finance is necessary, or that our knowledge of business finance is necessary if we are into that field of running or operating a business. The discussion here in business finance is closely tied with the discussion that we have in fundamentals of accounting, business and management. Wait for a while. I'll do a share screen. Share screen. Can you both see this? Okay. This one. Can you see this one? Nathan, Nicole, can you see this? Okay. What we have here is our lesson, which is still on the introduction to financial management, to where two important terms have to be defined, and you actually gave good answers in the assignment that was posted on Edmodo. Excuse me for a while. Sorry for the minor interruption. Sorry for the interruption. I'm so sorry. Okay. We now sorry. Okay, I'm good. I'm good. I'm good. I'm ready to go. Sorry. So we begin with defining the terms. The definitions that you gave out in the assignment are again very good definitions. But it's also nice if we both arrive, if the three of us arrive at a common understanding of how we see these terms in this subject. For the definition of finance, I'd like us to consider the definition of experts Gitman and Zutter 2012. They simply refer to the word finance as the science and art of managing money. That's simple. It is referred as a science because it needs some time, or yeah, it has some standards and things to consider. It is a particular area of specialization, and it is worth being, it has to be studied in order for one to really understand how finance works in a business. One needs to also study the field of finance, and it is also an art. It is just like how it went with accounting. Remember, accounting is also an art, and so is finance. As both of these terms are referred to as art, that means that when people do finance, they do it with a particular technique. They employ a technique or a style in managing money. And that science and art of managing money must be in the direction of the company's benefit. And by that, in extension, for the people who are part of that company, in the same way to the customers or clients for whom that company has actually been built or structured. Budgeting, I also asked you to define budgeting. Budgeting is the act of estimating revenue and expenses over a period of time. For a while, excuse me for a while. I am back. Sorry for that. Hmm. I muted myself. So there, budgeting is the act of estimating revenue. So you have income as well as the expenses that can be incurred in relation to the income that is being earned. So budgeting involves knowing what your expenses are. In the same way, you should also know how much you have as an available resource, money, how much you have that you can spend in order to meet the expenses that you have already prepared for. If possible, what is our goal? That we incur a loss or that the money reserve is more than our expenses. Of course, we would hope that the financial reserve that we have would turn out to be more than the listed expenses. We should learn to regulate the expenses that we have so that we will not run short of the financial reserve or financial allowance that is provided to us. Finance is concerned with decisions about how much of the earnings people actually spend or how much of the earnings they spend, how much they save or how much they need, how they invest their savings, and lastly, how they raise additional funds they need. So these are the focus for finance, earnings, and then in relation to earnings, how they spend or how much of these earnings have been spent with a goal that not all of the earnings have been spent. Second, with that amount provided, how much has actually been saved? Vis-a-vis to that, how much was just needed? Because if you identify or if you have managed to identify the value of the expenses, then you don't have to oblige yourself to go beyond the total cost of your expenses, since those are just what you needed. That more or less assures you that from your earnings, you can set aside a portion which you can call your savings. Next, how they invest their savings. We don't want cash to be idle. If possible, cash should grow. That is why people do investments or deposits. They put these cash that they have somewhere where it could grow. They would probably deposit it. They would probably put it on a time deposit in a bank so that even if it grows by a small percentage, at least the money will grow. However, there are also people who would not suggest that you put your money in a bank because the percentage of increase isn't as high. Oh my god. It's, excuse me. Sorry, sorry. Ah. Isn't as high or not as good. That is why instead of investing in saving or go depositing for depositing money in banks or putting money in time deposits, what others would do would be to purchase shares of stock. They study the stock market and then they wait for a good price by which they could buy the stock or the shares, and then they also wait for that right moment when the shares they bought can be sold at a good price. That also requires so much time. I mean, that more or less requires that you should look at the stock market for a good period of time. And lastly, how they raise additional funds they need. Additional funds may come out to be a necessity even if you have already had a number of earnings, you have a good deal of savings. Additional sources of funds might still be useful, especially if the business wishes to expand. Just because your business is doing well doesn't mean that you can just let it stay in its original status, like how it was at the start. You can do expansions. And doing an expansion might mean additional cost or expect expenses. So you might feel the need to raise additional funds. As we are now talking about finance and budgeting, then it's also imperative that we get to understand the forms of business organizations in terms of ownership. These forms of business organizations are in terms of ownership. We begin with a sole proprietorship, a business owned by one person and operated for his or her profit. So we have one person acting as the owner or proprietor of that business. Everything is under his or her control. Sole proprietorship does not mean that the owner is also the worker of the business. Take note, we're talking about ownership here. So if the person is, if there's just one person who owns the business, it's possible that that owner has hired a lot of employees. But the ownership of the business belongs to only one, to only him or to her. The owner is not sharing legal rights of ownership for that business with other people. Management obligations fall onto his hands. That's part of a sole proprietorship kind of business. Nathan, I think this is
Sir.
the kind of business that you want to have if you're given the chance to make one now. No,
Yes, sir.
this has something to do with the answer that you gave this morning. You want to be the solo owner of that business because you're afraid that if you meet an argument with a partner, your business will end up in bankruptcy. In your case, Nicole, in the store that you have in near your house, is that a sole proprietorship type of business or is that store owned by many?
Family, sir.
So it's a
Family.
family owned. So does that mean that that the members of the family have invested shares in order to build that business?
My father, sir.
Ah, wait. Ah, so your father is the one who owns the business. It's just that the rest of the members of the family are helping your father in running it,
Yeah.
in its operation. So it's safe to say that your store is a sole proprietorship type. Not that, yes, sir, my father owns the store and my father's, oh no, my tita is also with him. My tito has also invested for it, sir. So that's not the case. That store is really owned by your father. He has just been assisted by you as you are part of the family. So that's how it comes out. Okay, thank you. Rice's store, Rice's store, what is this? Shopper Smart, sole proprietorship. Is Shopper Smart a store that's a sole proprietorship type? It's not, correct. But later on, we will go into we will go into the category where the store of Risa belongs. Well, Risa really owns the store. Partnership. Oh, Nathan, this is what you're afraid of. Partnership. This is for a business owned by two or more people, plainly operated for the purpose of profit, because there is a desire to earn profit. Just imagine a sole proprietorship type of business that later on accepted another person as an investor. So two persons now are running the business, operating the business for the purpose of having profit. That is a partnership. For instance, Nicole has built a funeral home. And then Nicole called Nathan. Nathan, would you want to invest in this funeral home business that I've created? Hoy, Nathan, you should try to invest because every year We get to have customers, if not every month. And if we are lucky, we could have customers every week. And so Nathan got interested. Okay, I'll invest. And so both of you turn out to be the owners of the business for the purpose of profit. And so it's a partnership. Lastly, a corporation. It's an entity created by law, owned by shareholders. In a sole proprietorship and partnership type of business, the ownership is identified in terms of the persons who own them, like persons. In a corporation, there is an artificial entity that is created by law. And this artificial entity is actually owned by shareholders. Meaning, they will now divide, the composition of the corporation will now divide its ownership in terms of shares that shareholders can have from that business. The more shares you have, the more power you have over that business. Assume that the three of us own a corporation. Let's go with that funeral house corporation. Nicole's investment is 55%. My investment is 10%. And Nathan's investment is 35%. 30%. 35%. So from the three of us, the one who has the most number of shares is Nicole, while the one who has the least number of shares would be me with only 10%. So when it comes to decision making, much of it, though Nicole might feel the need to listen to us, listen from what we are going to say, but much of it can come from Nicole even without our approval. Or I make a decision and then, no, not or, sorry, wrong conjunction. If I make a decision, I'll still have to get the approval of Nicole, as she is the one with the biggest share in that corporation. So that's how corporations work. They work under the sharing of, that's the sharing that happen between or among shareholders. In the case of corporations, the overall objective of a shareholder is wealth maximization. What do we mean by wealth maximization? Wealth maximization happens when your share actually matches what direction your being a shareholder plays in that corporation. For as long as you get to exercise, you really exercise your being a shareholder, then you will have maximized your share there. Factors that affect prices. It's also important for us to know these factors because when we do finance and budgeting, and if we are on the side providing the business, we should know what reasons we provide if we change the prices of our commodities and services from time to time. These factors can be categorized as the ones controllable by management and those that belong to uncontrollable external forces. For the controllable by management factors, we begin with profitability. Profit is a measure, and this is really true. Profit is a measure of the financial performance of a company over a period of time. Although it is a major driver for increasing the value of stock, an investor should not rely on profits alone. It is possible that a company has profits, but its cash flow is negative. Take note of that. The company may be earning, but the cash flow must probably be too much. And it's still not beneficial to the company. That is why this is where one's knowledge of finance and most especially budgeting can come in. Another controllable factor, good liquidity and reasonable leverage position. Liquidity and leverage refers to the company's management of the type and amount of assets and liabilities that it will hold in the course of its operations. What are assets? Applied economics. Surely the term was mentioned. What are assets? Nathan? What are assets?
Your to like
Haha, sorry.
to gain is what you have gained, assets.
Gained? Something you've gained?
Hmm.
That sounds as though you're referring to the income. Gain. That sounds like the income. But assets don't really include income.
Oh yeah, liabilities.
Liabilities don't also include income.
Wait.
What are assets, Nicole?
The things you own, sir, like
Correct.
yung mga lupa,
Correct.
like that.
Correct. That's correct. Assets represent everything that the company owns. That includes land, correct. That includes the building,
Fixtures.
the
Fixtures.
fixture, correct. Furniture and fixtures. That also includes other properties, or if you have vehicles, assets include vehicles. Cash, that's part of assets. And again, let me use the words of Nicole, what the company owns. These are your assets. What about liabilities? What are liabilities, Nathan?
Things that you do not own.
What do you mean by things that you do not own?
Like
I think there's a better way of looking at liabilities.
expenses, like something.
Expenses are not necessarily liabilities because you might have incurred an expense, but you paid it through cash. So you don't have any liability at all.
Wait, wait.
So Nicole, what are liabilities? You're on mute.
Liabilities. Ano sa to? Hindi ko alam, sir.
You forgot already. Have you forgotten already? Liabilities.
Forgot, sir.
If assets are the ones that the company owns, liabilities are those that you owe other people or other entities. There are things that you owe them. You ought to give to them in the form perhaps of cash or a service that you have yet to perform to others. That's a liability. Whatever it is that you owe another party, that is a liability. For instance, the payables. Remember the payables? Accounts payable, notes payable. They are liabilities because an accounts payable represents a value that you owe another party in exchange for what you received from that other party. Let's try to concretize this. Your company bought, or you as the owner of the company bought a refrigerator by issuing, not issuing, bought a refrigerator on credit at an amount of 85,000 pesos. So what did the company receive? Nathan?
Refrigerator.
The refrigerator. So what does that make of the refrigerator? Is the refrigerator an asset or a liability? Nicole?
Asset, sir.
Correct. It becomes an asset because in that transaction, the refrigerator becomes a property of the company. It is now owned by the company. However, when that refrigerator was purchased, what was it paid through cash? Has it been paid through cash?
No.
No. It was bought on credit, correct. Therefore, the store where you bought that refrigerator has to receive from you an amount of 85K. That's the amount that you owe to the store. So that's your liability to the store. That is why, let's try to have a quick journal entry here. Refrigerator will be on debit. Accounts payable will be on credit. Because you owe that amount to the other person. Dividends. Holders of shares receive dividends from a corporation as returns on their investments in form of cash or other properties. Note that there may be times that companies do not pay out dividends because of future expansions. Dividends happen when you have a corporation. So that's their division, that's their share, the division that they get at the end of a particular period. But sometimes that's the dividends function as the return of their investments. But sometimes dividends might be opted for expansion purposes, might be used instead for expansion purposes. Besides, shareholders will consider this since it is also for the benefit of the corporation where they are actually a part of. In the long run, even if they did not receive dividends on the outset of the decision to expand, in the long run, they'll actually be receiving better dividends as the business has already expanded. Competent management is another controllable factor. Competent managers may have any of the following attributes. To those who wish to become competent managers, you should try to become visionary, meaning you're the kind of manager who sees a direction, who looks at the goal, who has a vision, who envisions how the business goes in the long run, or who envisions a good direction for the business. A competent manager is also decisive, must learn to stand on good grounds to arrive at a good decision. A good manager is also people-oriented. A good manager knows how to read the people around him or the people who are part of the market for whom that business has been built. A competent manager is also an inspiring manager. A competent manager is one that drives the employees to continue reporting to work. In the same way, that competent manager can also inspire the market to look into why the product should be bought or why that service should actually be paid for. A competent manager must also be innovative, must be creative, must not settle with must not settle with only the now, but try to forecast. The better term is forecast. Must try to also forecast what could be the needs of tomorrow. A competent manager must learn to be novel with his ideas, must not be too limited with the conservative ideas on how to run a business. A competent manager is a respected person because a competent manager knows, since a competent manager knows how to deal with people, he or she could position himself in a manner that could elicit respect. Lastly, a competent manager is an experienced or seasoned manager. Competence in management cannot be learned or achieved in just a year or two. It requires experience and immersion to the experience for quite a number of time, because these experiences contribute to how that manager could arrive at good decisions. To have all of these 7 characteristics or attributes would be so great. But it might not be that easy. It's not going to be easy to look for a competent manager that is visionary, decisive, people-oriented, inspiring, innovative, respected, and experienced or seasoned manager. It could be a combination of these attributes. Corporate plans, another controllable factor with the management is that corporate plans that improve the business prospects. Having more concrete future prospects, allowing investors to hope for better revenues and net income is good for the business. Macroeconomic conditions, political stability, prospects of the industry where the company operates, general market sentiment, the flow of foreign funds invested in the Philippine stock market, they all belong to the uncontrollable external factors. Macroeconomic conditions, how things are in the economy in a bigger scale, on a larger scale, like what's going on in the entire Philippine economy. That's a macroeconomic condition because it's totally uncontrollable, especially that you're just running your personal business or a small business. What happens in your own business falls into microeconomic conditions. The moment it gets to be affected by the economy of a national scale, like what happens to the Philippine economy, that goes with the macroeconomic conditions now. Political stability. It's possible that politics could affect the economic market. Prospects of the industry where the company operates. Who knows? The business you are doing might not be the demand of that time. Or the business you're doing could fortunately be what people actually are demanding of in a particular moment. In effect, you could set prices since, you could set the prices since you're the demand. If you're not, there's no reason for you to set the prices higher than usual because, again, you are not on demand yet, plus you're setting your prices high. You can't expect to have a good market if that's the case. Then you have the general market sentiment, how the market feels towards what you provide. If your market seems to become a fan or seems to patronize your products, your services, then perhaps you can try to increase by bit the prices of these products and services that you provide, because in the first place they will still patronize you for having done so well. You also have foreign funds, the flow of foreign funds invested in the Philippine stock market. These factors influence, it's not influences. These factors influence the general reaction of investors in making an investment decision. Its effect is not only to a specific company, but on all companies or a group of companies under similar circumstance. And such factors are a result of the environment a company operates in rather than the decisions of the company's management. So I think this is the last one now. What is the role of financial management? What is financial management for? Financial management deals with the decisions that are supposed to maximize the value of shareholders' wealth. Remember the goal of a shareholder? What is again the role of a shareholder, Nathan? What is the role of a shareholder?
Holder,
2 words. WM. Nicole, what's the role of a
wealth,
go Nathan, go.
Wealth maximization.
Correct. Wealth maximization. And that can be achieved with the help of financial management. Financial management guides investors, owners, shareholders on what decisions they should come up with in order to still maximize the value of their wealth. These decisions will ultimately affect the market's perception of the company and influence the share price. As then again, the goal of financial management is to maximize the value of shares of stock. There, the last part again. Managers of a corporation are responsible for making the decisions for the company that will lead towards the shareholders' wealth maximization. So it all goes back to that, to maximize one's wealth, maximization of one's wealth. Achieving it, achieving it would allow financial managers to have been able to contribute well or much to the shareholders. It's normal that every company or a corporation or shareholders would hire financial managers. That's quite expected. Especially for bigger companies, it's normal for them to have a person who is really referred to as a financial manager or a financial consultant. And then, just like what has been shared in accounting, these financial managers or financial consultants communicate information to business owners for the purpose of them arriving at decisions. I mean, as a shareholder, you're entitled to know the direction of the business or company to where you are a shareholder. If you are a partner of a business, whoever is the financial manager should communicate to you the profit or the loss that you are actually incurring so that you would know what to do, so that you can come up with decisions. All the more if you're a sole proprietor, if you're running a sole proprietorship, because as there's just only one owner, more or less the burden of how to make the business work is in your hands. Though you have people to assist you, the final say falls in your hands, as there's just one owner, as there's just only a single person who decides on how to run and operate the business. Financial management helps on this end. Questions? Questions? I'll stop the sharing of the screen now. Any question, Nathan, Nicole? By the way, please do not be surprised that sooner or later, there is a part in the discussion in business finance, computational discussion, which finds itself similar to what's going to happen in accounting. That's going to be expected. I don't know that if you've noticed that by now, there is a closure with the discussions in accounting and in business finance, right? They're quite synonymous. Because in the first place, accounting considers business, accounting considers finance. Finance is such an important element for those who involve themselves in the field of accounting. It's indispensable from the standpoint of an accountant to look into the finance of financial works or mechanics of a business. That's expected, that these two subjects are going to be tied up. Have you both seen the module now in Edmodo? The module in business finance is sent through Edmodo. Nicole, have you seen the module?
Yes, sir.
What about you, Nathan?
Yes, sir.
Nathan, hoy. Have you seen the module? Is there an FT in that module? Please try to double check.
Meron, sir.
Yes, sir.
Is there a set of questions that could be answered afterwards?
Yes, sir.
Okay, so the answers to these questions will be shared and discussed on Thursday. Questions? Yes, Nathan. Nathan, you have a question. You're on mute.
Edmodo.
Yeah,
Sir,
through Zoom. Through Zoom.
Like our answers about the NFT, will we put our answers?
You can just put your answers there. Or if you want, you can type in your answers in Edmodo. Anyway, we'll still use Zoom to discuss your answers.
Edmodo.
The good thing is that there are only 2 of you. So our Edmodo page will not be flooded with so many. If shall we agree? Would you want to reflect your answers in Edmodo? What about you, Nicole?
Post
in Edmodo. So just do it this way. When you put your post, when you type in your post, let it be labeled with a number 1, number 2, number 3, so that we would know that number 1 responds to question 1. Number 2 corresponds to question 2. You'll just have to provide your answers right away. But at least the number tells us
okay,
of what
sir.
question you're actually trying to answer. Let there be numbers in your post as answers to the FTs. Other questions? Other concerns? If there's none, that would be all for today. Goodbye and thank you.
Goodbye, thank you.
Bye and thank you, sir. Same.